one thing that's kind of interesting is it's, like I see a lot of different companies in the accelerator at 500. We have companies from all over the world. And so, as a Silicon Valley lawyer, I see, companies incorporated in Delaware, which is the most ideal situation, to companies incorporated in like Russia, which is frankly the most unideal situation. And I actually really want to thank you for coming this morning because you're brave. You really are brave. And the reason you're brave is that it's like 10:23 in the morning and you're doing a legal session. So I couldn't imagine a more dull thing to do at this hour. So really, kudos to you. And this presentation is a bit challenging because I go into some more advanced topics just very slightly, and then I do release some basic topics as well. But the idea is just to give you a sense of what I do in the accelerator. When I do my legal talk in the accelerator, it's pretty advanced. And basically I arm entrepreneurs with the ability to negotiate with investors. So with that in mind, I saw entrepreneurs raise their hands. I got a good sense for that. Who here is an investor? Cool, okay. And then I guess members of the media or service providers are the rest of that set. So the idea here is I want to give you all the tools to be able to negotiate with an investor. And investors, similarly, I want to give you a sense of how you negotiate with entrepreneurs. And really the most important impact or the most important aspect of doing deals well and either helping your investment fund or helping your company is understanding the terms you're entering into. I mean, who here saw Social Network? The movie with, yeah, right? The one where Zuckerberg got Zuckerberg. Or no, that guy got Zuckerberg. But the idea is like there's some like legal component to it. And there were some intricacies there that were kind of glossed over in the movie, but they actually had an impact. And they're true stories. Like this stuff happens in Silicon Valley all the time. So before I go into the nitty gritty, wait, how do I do the next slide? Do I do this? Oh shit. Oh. What button did it press? Oh, no. So a bit about myself. Oh, cool. Got it. So I was actually, I'm from the U.S., but I was actually raised in Muscat. I lived there for 6 years growing up. I actually visited Dubai before the Burj Al Arab was built. It's kind of funny. And then I went back to the U.S. I went to Georgetown University for college, and then I went to NYU for law school. And then I worked at a big corporate law firm in New York where I represented hedge funds, PE sponsors, and big public companies. So I represented Bain Capital, Golden Gate Capital, Vista Equity Partners, Bristol Myers Squibb, Burger King, all great entities, so to speak. And then it was like one really cold winter in New York when I decided that I hated this weather because I was raised in Oman, so the weather there was quite lovely. So I was like, I'm going to California, and I'm going to do venture capital law. And so when I moved up to Silicon Valley, I worked at a firm out there, and I represented pretty much every major venture capital fund on Sand Hill Road. That's sort of the road where most of the major VCs in Silicon Valley are located, weirdly enough. And then I also represented a lot of companies outside, company side and investor side. So I represented Facebook, King.com, the maker of Candy Crush, Jet.com, which is doing really well right now, trying to compete with Amazon. And then now I'm at 500 Startups. I'm one of the in-house lawyers. I oversee all of our investments. I think someone said 1,600 companies. When I made this presentation, it was like 1,300 companies. I feel like the number is always increasing, and I can't be bothered to update it. But either way, I probably am the most active VC lawyer in the world. So it feels kind of like a dubious honor. I think the number one that color's kind of off. Interesting. So the number one principle or thing to know as you're doing a deal or you're even starting a company or you're looking for investment is knowing yourself and knowing whom you're going to target for investment. I think a lot of times I get people who enter the accelerator in San Francisco or Mountain View who are asking me, Neil, where should I incorporate? Where should I, keep my legal entity? Should I put it in Delaware, even though I'm based in the Middle East? Should I go to the BVI or Cayman Islands? Should I do Cyprus? Should I do Singapore? Should I do the UK? And my answer to them is always, well, whom are you trying to get money from? Like, whom are you targeting? I think, a big factor in sort of how you decide to raise your funds, or how you raise money for your startup, is knowing what your investment audience is. So just like I'm doing this presentation and I asked you all, who here is an entrepreneur, who here's an investor, when you're a company, I want you to understand, what kind of investor am I going after? Am I going after Andreessen Horowitz in Silicon Valley? Am I going after, Wamda here in the Middle East? Because that answer will impact what you do. I can say right now, if your goal is to raise money in Silicon Valley, then you should probably be incorporated in Delaware, like 99% of the time. So if a company comes to me and they're like, Neil, what should I do? I ask them, well, what should you do? Well, where do you want to get money from? You want to get money in Silicon Valley? You incorporate in the U.S. Do you want to get money in the Middle East? I'm not sure that incorporating in the UAE is the smartest decision. I think, it's one thing to be based here commercially, but you want to be able to be in a jurisdiction that has a lot of good commercial law and a history of commercial law. And so the Cayman Islands and the BVI are typically where I see a lot of Middle Eastern sort of companies be incorporated. And the Cayman Islands and the BVI, are great places. They're great places to vacation. But they're also great places to incorporate your company because a lot of international investors are very accustomed to that. I notice like international investors in Singapore and in Asia more broadly, the Middle East, and even in the U.S., they'll sometimes venture out of the U.S. by investing in a BVI company. So it's not a bad deal. So I really think the BVI and Cayman are great places to incorporate. You want to be conscious of what your costs are going to be to incorporate. If you decide you want to incorporate in a really weird country like Russia, that could cost you a lot of money. Lawyers are not cheap. And I'm going to get to that part in a bit in this presentation. Lawyers are very expensive. But if you go into a more commercial jurisdiction where there's a really, really substantial and sophisticated corporate law regime, and where there are a lot of lawyers, that drives prices down and really makes us commoditized. And my practice as a lawyer is I like commoditizations because I think lawyers are unnecessary. And it's funny that I say that because now I'm unnecessary. But I really think that, as a startup, you should be focusing on your business. As an investor, you should be focusing on investing. And the more time you spend on this legal bullshit, the more time you're just like killing your brain cells and wasting money. So my goal as a lawyer is to minimize that. And I like to see companies incorporated in jurisdictions that minimize cost, time, complexity, brain damage. I get companies in the accelerator. I have one company in the accelerator that was incorporated in the UAE, and we still haven't closed our investment. And this was over 8 months ago, not because of anything on our end, but because they had to reincorporate, and then they took forever to do that because there were tax consequences to reincorporating. And every time I get on the call or I read an email from their lawyer, I want to kill myself because I'm like, I don't want to read this stuff. It's so long, and it's so unnecessary for a company of that size, So it's interesting. When I was representing, Bristol Myers Squibb, they could easily accrue over $2 million in legal fees doing, their $10 billion transaction. But as a startup, you shouldn't be accruing $2 million in legal fees. Frankly, you shouldn't be accruing more than $30,000 of legal fees. So I really want to see you all avoid that. Any questions so far? So, that's an interesting question. Zafar asks, a lot of companies here want to be registered in the free zone or in Dubai more broadly. And how does that interact with being a BVI company or a Cayman Islands company? I want to urge you all to divorce your conception of incorporation from where you're based. I would say 80% of the companies in the US are incorporated in Delaware. But about 75% of that 80%, about 90% of that 80% are not based in Delaware. Like Facebook is incorporated in Delaware, but I don't think they do anything in Delaware. And more to that point, Apple, they have companies that are incorporated in Ireland, though we all know they're a California company. And they do this for complex tax reasons, for, the legal regime in Delaware or in the BVI or Cayman are very favorable to companies. And so, in terms of your specific question, I would recommend you talk to a lawyer here who is familiar with not only sort of BVI and Cayman law, and I have referrals. If you want to reach out to me after this presentation, I can give you referrals. Who's familiar with BVI law and Cayman law, but also sort of Dubai law and how they interact. One suggestion that I'll make is no investor will ever invest, or I would never counsel an investor to invest in a shell company. And by shell company, I mean a company with no, that sits as sort of a parent of a company where all the assets sit. I want to invest in a company where all the assets sit because I want my money to have skin in the game, really. Like, if my money is in a shell company, then, I don't really have any access or any rights to the assets of the company.
Sometimes we don't have an option. Like, to employ people in Dubai, we need Dubai registration.
Yeah, so you can.
Then to get investors, the investors wouldn't want to invest in a free zone company. Like, a lot of the investors, even here in the Middle East, would say we would prefer if you were a BVI company. So, Neil, when would you recommend to the founders here to set up the first one, the Dubai one, which they need from day one? And when do they go and set up the BVI one that sort of owns?
So that's also a really good question. I recommend that you set up both at the same time or as soon as possible. And it should not be expensive. Here's why it can become expensive if you don't do both at the same time. Suppose you incorporate or you register your company and form it in Dubai, and your company becomes a runaway success. Your intellectual property is worth something. It's worth millions of dollars. And suppose the knowledge of your employees, their intellectual property in their heads is worth a ton of money. And then suppose down the line you're like, I actually want to scale this up and I want to get venture capital investment. Maybe I should incorporate it in the British Virgin Islands and transfer the assets to that entity to get that investment money. The problem with that idea is that now that sort of substance is valuable, the moment you transfer it to the BVI entity is the moment that the BVI entity has taxable consequences. So it's really easy for me to transfer something worthless to somebody else because I don't have to pay taxes on it. The recipient doesn't have to pay taxes on it. But the moment you have something of value and the moment it gets transferred is the moment you ask a lot of tax questions. And now, in the US, it's kind of easy because if we're switching from a Delaware LLC to a Delaware C Corp, who really cares, right? But when you're switching between international entities, a Dubai entity to a BVI entity, and you're doing transfers, that becomes an international tax question. And that is not cheap. The most expensive lawyers in the world are international tax lawyers. They're probably around the range of $1,200 an hour. And that was as of like 3 years ago when I had access to my law firm's billable rates. They are probably substantially higher, closer to $1,500 an hour right now for international tax advice. That stuff is not cheap. So I urge you to think about this all up front. And this is one of my other pieces of advice here. Don't think to yourself, I'm just focusing on my company right now. And I get it. Like I said, it's very important for you to focus on your company. But don't be cost conscious to the point where you're, ignoring important legal advice and you're setting your company up for failure from the very beginning. If I was representing an investor, and I have represented many investors, and I know we're investing in a company, and I know that company has a 6-figure or even 5-figure tax liability sitting on their financials, I'm not going to invest. Or as a lawyer, I would tell the investor they should probably reconsider the investment. So this is something that could shoot you in the foot. It really can. Any other questions? I also want you to understand the investment instruments that you're going to be using to get money. So who here knows what a convertible note is? One person, another person, quite a few people. I want you to be armed with this knowledge because suppose you know who you are. You are a company based in Dubai that's either raising money in the US or internationally, and so you know where you should be incorporated. You've answered these questions in your head, and you've set up all the legal structures to receive money, from an investor and to pitch that investor. the next question you have to ask yourself is, how do I want to receive that investment? What form should that investment take? And the worst thing you can do for yourself outside of being poorly incorporated and having a bad balance sheet or bad financials or bad tax situation is to not know the basic lingo that Silicon Valley operates on, or that an investor, a venture capital investor around the world operates on. And this is so important because if you sound like an idiot, sort of worst case scenario, the investor backs out. Best case scenario is they take advantage of you. And neither of those scenarios are pleasing to me. Obviously, some money is better than no money at all, but I'd prefer that you get that money on really competitive terms. And so if a VC investor tells you, hey, I want to invest in a convertible note, and you say, what's that? That does not look good for you. It makes you look like an idiot. And so, you're probably a really smart person, but if you're not familiar with the terms, people judge you very quickly. And a first judgment is very hard to shake. So be smart. And if you don't know, if you're unfamiliar with these things, I do a quick primer here, so I'll teach you what a convertible note is and how it works in this sort of 5-10 minute scenario. But the corollary to this is don't be afraid to ask your lawyer questions. Don't be afraid to read resources online. The internet's rich in information. VCs love to talk. In fact, they talk too much. So, take advantage of that. Read about it. Ask questions to VCs on Twitter. And ask your lawyer questions. I think that's really important. So the way a convertible note works is, say you want to get $1 million of capital in your company to do operations. And you say to yourself, oh my God, $1 million is a lot of money. And I don't want to, spend a ton of money getting that money. I don't want to spend $30,000 to get $1 million. I want to spend maybe $10,000, or in some cases even less. Or suppose you really need that $1 million really, really quickly. You want to start ramping up very soon. You have a star employee that you want to hire, and you don't have the resources to pay them the salary that they deserve. So you want to hire them quickly before you lose them to some other company that is also trying to hire them. So convertible notes are great for that. They're great because they're cheap. They're great because they're quick. The way a convertible note works is, an investor will lend you money, and then over time, you use that money for whatever purposes you have to use that money for in your company. And when you have your first actual round of financing, like a Series C or a Series A, oh wow, I'm already zooming through my time. A Series A financing, that money will convert into equity in the company. And the important thing here is that a convertible note or a convertible loan is a fiction, all right? I call it a fiction because it's not really a loan. When someone's lending you $1 million, it's not meant to be something that you pay back. And if an investor ever says, I'm going to try to collect my money from you down the line, you run away from that investor very quickly. A bank lends you money. An investor gives you a convertible note or an equity round investment. They don't lend you money in a traditional sense. So this money should never actually be due. 500 Startups has never collected on its loans in its history of the fund, and so long as I'm the lawyer for 500 Startups, you will never do that. And even worse, some investors might ask that you secure your assets for this loan. They might say, oh, hey, not only do I want to give you $1 million, but I want this $1 million to be tied to your intellectual property, to your computers, to your real estate, whatever. And if you default on the loan, we'll collect all of that. That's really bad, and I would never do that. Oh. Yeah.
Most investors in the Middle East will tell you that in Silicon Valley, this is how it's done. That you need to actually give your assets and they will have clauses where they could actually get you to pay them in cash. And I don't want to say it happened to me. It happened to a good friend of mine. There are VCs in the region that will definitely do this. In the Valley, this is not a best practice. It does not happen. And if ever an investor tells you that this is how it's done in the Valley, please tell them that it's yeah.
Or, shoot me an email. I think one of the biggest things about 500 Startups coming into regions and investing is making things really founder-friendly or just more even between investors and founders. And so I think, if at the end of the day I sense that a founder is getting taken advantage of, even if I'm not investing, I feel personally offended by that. So feel free to talk to me. I'm happy to talk to investors. I'm happy to help out. I'm trying to go to this next slide, but it's not letting me do that. Ugh. Oh, man. There. Oh, so I basically explained that. You know, if this clicker was working, you I would have. Oh, there we go. Okay. So key terms of a convertible note. It's really easy stuff. It has a maturity date. That's just to make it look like a loan. When you hit 36 months or 12 months or whatever, I'm not going to collect on the loan. Really, what I'm going to ask you to do is, if you haven't, converted into equity at that point, I'm just going to ask, hey, how's the company doing? You need me to extend the maturity date? I'll extend it for you. That's totally fine. It'll have an interest rate, but that's only, again, for appearances. Yes, the interest accrues, but that's just more money that'll convert into equity. The interest rate is supposed to be very low. Typically, in the U.S., it's the applicable federal rate, which is very easy to find online. You go to Google, you type in applicable federal rate, and then you add 1 or 2 basis points. Typically, it has a discount. I convert into equity at a substantial discount compared to another investor down the line. So if you're selling equity to an investor down the line at $2 a share, and I negotiated a 20% discount, my balance plus interest will convert at 80 cents a share. Really easy. It'll sometimes or frequently have a valuation cap, which means that if you sell your shares at a valuation of, say, $5 or $6 million, and I've negotiated a valuation cap of $2 million, the cost of my conversion will never exceed $2 million, despite the fact that the investor is investing 1 year later at a $10 million valuation. Typically, the note will only convert in certain scenarios. Our notes only convert if you raise at least $1 million in new money from an investor in an equity round of financing. By equity round of financing, I mean you actually start selling shares of your company. The important thing to know in a convertible note is that when I'm lending you money as an investor, I'm not buying 5% of your company. I'm not buying 10% of your company. I am literally giving you money to put in the bank, and you have borrowed money from me. I'll only have a percentage ownership in the company when it converts into equity down the line. It's covering up my terms. And then sometimes we'll also negotiate for what's called an acquisition premium. If your company is acquired before our money has had a chance to convert into equity in your company, we'll get 2x return on our investment. So if we've lent you $100,000 and the $100,000 is not converted into 5% of the company and your company is acquired, I'll get $200,000 back, assuming there's enough money to go around. Number 3, another structure you should know is a price round or an equity round, or what's called here or elsewhere in the world is Series A financing, or a Series Seed, or a Series B, or a Series C. One thing I want you to know about these things are these are just labels, all right? Like, I can call anything I want a Series A. And in fact, some investors in Silicon Valley will trick you by calling something a Series A so you can get all dazzled and be like, oh, man, I have a Series A, when really it's just a seed because of the economics of the deal. But really a priced round means that you're selling shares in your company. You're selling 5% of your company for, say, $1 million or $2 million or $3 million, whatever. Who here watches Shark Tank? Yeah, that's good. So you'll typically see Mark Cuban, you'll see Rob Herjavec, Barbara Corcoran say, what? Kevin O'Leary, who, by the way, offers the best deals in Shark Tank, even though everybody hates his guts. It's actually really surprising. I think he offers the best, the most founder-friendly deals on Shark Tank. But because he's the most mean guy on there, nobody wants to take a deal from him. It's actually really interesting. So they often say, I want $300,000 for 15% equity in my company. Those are priced rounds, Somebody's saying I want $1 million for 20% of my company. They're saying their company is worth, what's that, $5 million. All right? So yeah, a Series A can be a fund giving to the company, money. So Series A, a price round doesn't tell you what investors you have. Angels can do a priced round, or a fund can do a priced round, or Mark Cuban can do a priced round. I can do a priced round. If I'm buying shares in your company, I'm pricing your shares. I'm saying this is the value of your equity, and this is what I'm going to pay for it. So anybody can do a price round. And in fact, I'll tell you that if an angel is telling you that they want to do a priced round, question that. That's actually really bad. Because, so one thing that's funny is in the UK, they have convertible notes and they have priced rounds, but they have an interesting tax law where if you're an angel investor and you invest in a priced round and not in a convertible note, you get to deduct that money from your taxes 100%. That's a really crazy tax deduction. But the problem is that it gives the incentive of angel investors who are not always sophisticated investors to give you high valuations for the purposes of getting a tax break. This causes misaligned incentives, and the worst thing you can do for your company is have a valuation that's too high. Because if you have a valuation that's too high and you don't have the metrics to justify it, you're shooting your company before it can even grow. Here's a classic example. You're a food company, that's operating a food delivery business. And your model is, I want to deliver 3 Michelin star meals for $75 a meal to every person that orders it in half an hour or less. Wait, I actually don't think this company exists. I might have developed a company that might actually work in Dubai, right? I deliver Nobu sushi in like 20 minutes or less. And then you think to yourself, oh man, like how do I do this? How do I get these restaurants to come on board? Gordon Ramsay, this guy's awesome. I can get him to invest in my company. And Gordon Ramsay loves the idea. But Gordon Ramsay is a chef. He's a great personality. He has a great TV show. But does he know anything about investing? Probably not. He might know about buying restaurants. He might know about starting them. But does he know about VC investing? Probably not. And so if he says to you, I'll take 50% of your company for $200,000, you run for the hills. Don't get starstruck. Don't say, hey, Gordon Ramsay, I really need you. I'm going to do this. That, as if I was representing a VC and I saw Gordon Ramsay on the cap table with 50% of the company, I would say, I'm not investing in this company. I'll just go to Gordon Ramsay and say, I'll invest in him. You say to Gordon Ramsay, like, hey, let's do a convertible note. All right, let's do a convertible note. And by the way, I'm not making this stuff up. We actually had a company in our accelerator that had a UK chef celebrity who did a deal, and I advised them not to do that, and they did it anyways. That was very infuriating. So he's asking if you have a choice between a convertible note and a priced round. I recommend a convertible note for early stage companies, like very, very early stage. I think every region is different as to what requires a Series A. In Silicon Valley, if you're a repeat founder with no product, no revenues, but you know what you're doing, you can get a $100 million valuation from Andreessen and do a Series A. And this is a true story. But in some other countries, it's harder to justify that. For more traditional VCs, they might want to see traction, product. They might want to see more of a business there, So in every region, the answer is kind of different. But my recommendation to you is if you're pre-revenue or pre-product, probably do a convertible note. 500 startups, our first check is almost always a convertible note. Almost always. The fourth thing I want you to know is price. What are you valuing your company at? Who here knows if an investor comes to you and says, I want to do 5 on 20, what that means? Someone says to you, I want to do 5 on 20. Nobody knows what that means? 2 on 10? You know what that means. No one else? When someone says 5 on 20, 2 on 10, X on Y, they mean I want to do a round of financing, a price round of financing of X dollars of new money being injected in your company on a Y $1 million pre-money valuation. If they say I want to do 5 on 20, that means they want to invest or have $5 million of new money come into your company at a $20 million valuation. After the company financing is complete, it becomes a $25 million company, 5 plus 20, with the investor owning how much of the company? 20%. Really easy. Really easy stuff. Pre-money valuation plus $5 million, $25 million. I made this company up, Royalty. And suppose the founders own 100% of Royalty, and an investor owns 20% of the company. The founders now own 80%. So the financing is 20% dilutive to your founders. So by the way, Royalty is a company started by Beyonce and Lorde. It's a tea company. Um, they're good entrepreneurs, I guess. Who here? So another important question about our company is, um, I'm the founder, or I have a founder team, and I'm trying to hire employees. You need employees to build your company, right? But how do you incentivize your employees? Suppose you're paying them. You can't match what Facebook's paying them. You can't match them what Microsoft is paying them or what Google's paying them or whatever. How do you compensate for that? Any ideas? Stock options. You said something else? ESOP, yeah. That's exactly right. You give equity. The problem is that suppose, suppose you have 80% of your company, your investors have 20% of your company, and now you need to establish an option pool to give options to your employees. Suppose you establish a 10% option pool. Who does that dilute? Both of you. So as an investor, if I'm representing an investor or I am an investor, in this case I am an investor, I think that's bullshit. I think the founder should suffer that dilution, not the investor. So if typically when an investor is coming into a round of financing, they'll say, I want you to establish a 10% option pool so you can hire your employees, and I want you, the founder, to eat that dilution, not me. Typically the way it's phrased is, I want to do 5 on 20 with a 10% option pool coming out the pre. I want it to come out the pre-money valuation. I don't want to pay for your option pool. That's going to be even more dilutive to a founder. Suppose you have a $20 million pre-money valuation. Investor asks for a 20% option pool, so that's basically equivalent to $4 million. So that's going to be 20% dilutive to founders. And then when the investors take 20% of royalty, 20 plus 20 is 40, it becomes 40% dilutive to founders. And really the price becomes a $16 million pre-money valuation, despite the fact that it's 5 on 20. I think in terms of percentages, 20% is very high. I think 10% is what you should be aiming for. There's a really great blog post by Fred Wilson. He's a VC in New York. He works for Union Square Ventures. He says that whenever an investor asks for a really high option pool, he or she is really negotiating about price. And you should, if an investor is really asking for 20%, say to that investor, what are you trying to do to me? Do you really want to incentivize my employees, or are you just trying to buy your shares more cheaply? Because if that's the real question here, let's negotiate that and put the option pool as a separate discussion. So you can just type it in Google. Type in Fred Wilson option pool AVC. You'll find that blog post. It's genius. I think his whole blog is genius. Read it. Or you can raise a pre-money valuation. But that's price, right? The higher the valuation is that you're selling your company for, you're selling your shares for, is the higher the price of the shares. But that's exactly what I want you to be conscious of. And on the flip side of that, don't be incentivized to go for a really high valuation. I know it's great to go to a bar or go to smoke shisha and tell your friends that I've raised a Series A $100 million pre-money valuation. But unless you're a repeat entrepreneur, I'm going to laugh at your face because I think that's insane. Who here watches Silicon Valley? A couple people. The TV show. Great show, by the way. It has a lot of real-world scenarios. There's an Indian guy who raised his Series A at a $40 million valuation, and he couldn't raise a Series B because he couldn't convince an investor that his company was worth more than $40 million. So you had to do a down round, which is when you raise money at a lower valuation subsequent to your first round of financing. And that is really bad signaling. And then Richard told him, why didn't you raise at a lower valuation? You wouldn't have this problem now. And he said to himself, oh my God, why didn't I think of that? It's stupid. Don't chase high valuations unreasonably. Number 5, understand what a liquidation preference is. This is only applicable in a priced round of financing. When I buy shares in your company, if your company is sold, as an investor, I get my money back first before you guys do. All right? That means that if I invest $1 million in your company and your company is sold for $500,000, I get all $500,000 and you, the founder, gets nothing. All right? If I invest, $1 million and your company is sold for $10 million and I own 10% of your company, I get the better of 10% or my money back. In this case, it's the same. If your company is sold for $20 million and I've invested $1 million, I get the better of 10% of $20 million or my money back. In this case, I get $2 million. And then the founders keep the rest. But remember, it's the better of. So I did this little chart here. This is a sample of a company that's a pretty late-stage company. This is actually pretty realistic. You know, you have your founders, you have your advisors, Ashton Kutcher, Mark Cuban, your option pool, you have your Series A investors, then your Series B, Series C, Series D. These are all investors you typically see at various stages. This is how they get paid. I think Equities then did a model for when Square went public, who got paid what and who got paid first. Very interesting analysis. A lot of blog posts, a lot of text was spilled over that because they did their IPO at a valuation lower than their last valuation of financing. And some blog posts were saying, oh, the investors got screwed. The investors did not get screwed in that. Believe me, they did not. They made a lot of money. Founders also got a lot of money, but the investors got a lot of money too. The bloggers who wrote those articles, they didn't know what they were talking about. It was kind of funny. But yeah. So remember, when an investor comes in, they buy preferred shares. As 500 startups, I never advocate buying common shares. Common shares mean I don't have preference. I don't have liquidation preference. If a partner comes to me and says they want to buy common shares in this really hot company, I tell them to get out the room and renegotiate the deal. Because in this situation, in this rare situation, the founder is exploiting them. Yeah, so sometimes a liquidation preference, an investor might negotiate for what's called 2x liquidation preference instead of 1x liquidation preference. That means the investor gets the better of, if they negotiated 2x liquidation preference, they get the better of 2x, or say, if they own 5% of the company, 5% of the merger consideration. That means they get paid 2x first before you, the founder, gets your money back. I would say right now, 1x is the most common thing you should be going after in a price round. If anybody says 2x, I would say you're either in a market that doesn't have a lot of investors, which could be the case, or you're in a market that's in a recession. So in Silicon Valley, when the dot-com bubble bust, we saw 10x liquidation preference. That means the investor got the better of 10x or whatever, 5%, 10% of the company, the consideration, before the founders got their money. That's really bad money. That's not smart money. I would never take that. In my opinion, if I saw a term sheet with more than 2x or more than 1x, I would say run for it, unless you need the money. If you're desperate for the money, that's a different question. Good question. I was debating whether to introduce that concept because I didn't want to complicate things. So participating preferred is the idea of, suppose I've negotiated 1x liquidation preference participating. That means if a company is sold for $10 million, I get my 1x back, and then if I own 10% of the company, I get 10% of the $9 million. That's called, does that seem unfair to you all? That seems kind of unfair, right? It's called double dip preferred. And it's pretty rare. I would never want to give 1x participating because they get to dip in twice. They get to dip in their liquidation preference, and they get their share of whatever's left over for the founders. That's pretty sad. Really? Don't you wish I was your lawyer? I would never do participating. I would be like, this is a bad term sheet. Yes. It gets worse and worse and worse as more investors get in. I want you founders to get rich, man. I don't like it. You start your companies for a reason. Yeah, you love the product. Yeah, you really believe in it. But you want some money, right? That's why you're sacrificing your blood and sweat. So that's a good question. Where did the idea, if 10x or participating are so bad, where do these terms come from? I say they come from illiquidity. I think liquidity drives terms. When you're in a market where there's a lot of money, a lot of cash, where cash is cheap because interest rates are so low, you have really founder-friendly terms. In the US, ever since 2008 hit, and the Fed established 0% interest rates, there was no better place to put your money in than in like anything else but cash. If you're keeping money under your bed, You invested in a startup, right? And the problem with that is that put a lot of dry powder. Dry powder is the business speak for cash. A lot of cash out there to invest. And the problem with that is that there are only so many companies to invest in. There are only so many viable companies. And what you saw in Silicon Valley was, frankly, really bad companies getting really good investment terms. In 2013, 2014, a lot of bad companies were fetching very, very high valuations and were getting very, very cheap money. And the problem is that when they say winter's coming in Silicon Valley, you're going to see a lot of those bad companies get exposed because now they can't raise a Series B with the higher valuation because there's less money to go around. So you'll see kind of a float to the top of quality in terms of the companies that survive. Interest rates are still low, but they still got high. They got to, I think, it's 0.75 right now, or 0.5. That's still higher than 0%. And I think that influences things. That for any investment fund, for a VC, that doesn't influence things because they have to invest in startups. But in terms of LPs who invest in VCs, that changes their mentality. That maybe changes their allocation. Maybe I want to invest in less VCs and fewer VCs and more private equity funds or hedge funds. And as money gets more expensive, as interest rates go up, that changes things too. But that's the US though, right? What about the UAE? Maybe interest rates are still low. I don't know what the interest rate is here, but there might not be as many investors here with as much money, right? And so there are fewer investors and fewer VC dollars to go around. That still reduces liquidity. And when there's lower liquidity, you find terms like this. There was a company raising money in Palestine that had an investor asking for 2x participating and full ratchet anti-dilution, which I haven't explained here yet, and I will explain shortly. But full ratchet is so uncommon in the US. It's in less than 1% of Series A financings. And when I heard that, I was like, that's insane. But then again, in Palestine, how many VC investors are there? Like one, if that. It's not a lot of liquidity. So, hey, they can get away with that. This is just sort of an example that I made. You can sort of take a picture if you want to, but it's like a $30 million acquisition offer. A investors invested $1 million. They got 20% of the company. They got, $6 million back, and $24 million for the rest of the founders. They get rich. This is 2x participating or 2x non-participating. Again, $6 million doesn't change things. Another aspect that I want you to know is corporate governance. I'm going to explain this about Delaware corporate law, U.S. corporate law, because that's the most common. Things change in other countries, but they're largely similar. So I want you to take this lesson away with you. Just because you're the founder of your company, that doesn't mean that you control your company. All right? In Delaware, or the U.S. more generally, the shareholders elect the board hires the officers, and the officers hire employees. That means that if you're the CEO of your company and you don't control your board can fire you. That means if you sit on the board of directors of your company and your shareholders hate you, your shareholders can get you fired. Now, this is not a problem that's only happening to startups. You might think to yourself, oh, Series A investors coming in, they're giving me a ton of money. They want to control my board. That's fine. That's not fine. The very first episode of season 3 in Silicon Valley, Richard Hendricks gets fired. And yes, this happens all the time. And you know what? This is not just for Pied Piper. This is going on at Yahoo right now with Marissa Mayer. There is a activist hedge fund, I think it's Starboard, who's taking control of the company, and they're cleaning house. They're cleaning out the board. They're installing their own board members, and they're going to fire her. This happens all the time. You're seeing this in New York with Valiant. Bill Ackman, who's an activist investor that I used to represent in New York, he's cleaning house. That's his business. He cleans boards out and then fires CEOs and gets new CEOs. Understand this. So as an officer, as a CEO and founder of a company, you hopefully have a board seat. Hopefully you're not giving your other board seats away like candy. Any questions? So not automatically. The officers are different from the board of directors. So it might be different in UAE law or in BVI law, though BVI law is pretty similar to Delaware law. Only the board can fire the officers. Your shareholders cannot fire a CEO. Yeah, in that case, no. Yeah, if there's a conflict of interest, typically if there's a conflict of interest in a transaction or in an event like a firing, by law, at least in the US, but again, I think this is something that applies in most parts of the world, you have to take a subset of the directors who are disinterested and get a majority of those board of directors to fire the CEO. That doesn't work out favorably for the CEO because that means the CEO's vote doesn't count. So that's even worse. Founder is typically whatever role you want to give yourself, right? If you're just starting a company, hopefully you're the founder, you're the CEO, and you're a board member, right? Yeah, but suppose you have two founders. You're both CEO, CFO, two board seats, right? The danger is, so think of them as two different hats that you wear, right? You put on your board member hat, you put on your CEO hat. They're different hats that you wear with different responsibilities and duties. If you have a 4-person board, but only 2 people sit on it right now, that's 2 founders. Say you have a 5-person board with 2 people sitting on it, you're 2 founders, and then you give 3 investors 3 seats on the board, that suddenly means that those 3 investors can fire you if they don't like you. That's the danger. You mean like 2 votes per 1 seat or something? So that's not as common. I would typically try to do 1 vote per seat. You only really see like the idea of 10 votes or 15 votes or whatever per seat in very late stage companies that are trying to maximize for board control. But it's not very common. It's very rare to see more than 1 vote per seat. And I would never do that. I would never try to sway away from that standard. I'll explain it in 1 second. I'll get to that in 1 second. I have a slide on this. Oh, for every stage? So typically for a Series A, your biggest investor will take 1 board seat. Maybe 2? Probably not 2. Series B, 1 board seat for the lead investor. Series C, 1 board seat for the investor. Between founders and board members, between founders and investors, the ratio is typically investors want to have some control over the company. So probably like more than majority. So probably like 1 to 2. In a Series A company, you can get away with 2 to 1. Founders, 2 founders for 1 investor. For a Series C company, board members will typically want control. But if you're a hot company, exactly. And I'm glad you said that. I'm really glad you said that because a lot of founders tell me, look at Uber. They're doing great. They have control of their board. And I'm like, yeah, look at Uber. They're a $60 billion company. What are you, like maybe $1 million company at this point? Like, let's talk about when you are Uber. That's a good question. That's a good statement. A lot of companies, that Uber scenario is like 0.1% of VC-backed companies, right? Like, it's unrealistic to think of that scenario. Yeah. Yeah, I agree. I think in the early stage, yeah, you should control your company. But really, you shouldn't view it as a battle between you and your investors. You shouldn't view you and your investors as at odds with each other. Your VC is your partner. They invested in you because they want to help you out, right? Yeah, you're both getting rich, but it's a mutual arrangement. If you sense you're entering into a relationship where your VC might want to fire you down the line, actually might want to fire you, and you don't like them, maybe you should reconsider that VC, you know? That said, don't overly trust your VC. They're not your best friends. If they sense they can install a Steve Jobs, or sorry, in this case, a Tim Cook, and fire you, and make the company 10x in value, they'll do that in a second. Yeah, your shares will be vested, but but typically you won't have majority control of your company. And typically an investor will negotiate that only certain actions can happen with the company with their consent. So, and that's standard. So you don't have a lot of control in your company. And I'll get to the situation in a second. Board structure. Zafar, you're asking about that. This is what I would probably typically see in a Series B-ish board structure. Series, like a pre-Series A, I expect all founders to be on the board. You never give a board seat to a convertible note investor. Never, ever, ever, ever do that. This is a very typical board structure I see for a priced round company at a Series B. 2 VCs, a founder, an outsider who's kind of neutral. Say it's a friend, a mutual friend of both the investor and the founder, and the other founder. Oh, sorry. One caveat. This is flipped around. The left is investor friendly. The right is founder friendly. Sorry about that. Who wants to guess why one of these is investor friendly and the other one is founder friendly? What's up? Exactly. So to tease that out a little bit, if your board seat is tied to you being an officer, if the agreement says you're only a board member insofar as you're an officer, you're the CEO of your company, if your board fires you, that means you lose your board seat. Whereas in this scenario, you could be fired as CEO, but you can still sit on your board. Granted, a lot of VCs don't like that. In their opinion, that you shouldn't sit on the board because if you sit on the board, you have an axe to grind. If you're fired as a CEO and you sit on the board, you have nothing positive to contribute at that point. Except throwing spaghetti at the wall or something. I don't know. Point is, you're not a happy camper. And find somebody else. Find like find another officer of your company. It doesn't have to just be a founder. It can be your CFO, whom you can give a board seat to that's not tied to their status as CFO. If you trust that person, give that person the board seat. Or get a friend on the board. It doesn't have to be someone who's working for your company. It can be, say you have a really trusted friend who's the CEO of another company, and you're like, hey, this person's great. They add a lot of value, a lot of good business judgment. Don't do that guy who's like your childhood friend who is a really good drinking buddy. Like your investor's gonna be like, who on earth is this guy? Why is he sitting on my board? But if you think this person's gonna be a good contributor, have them sit on your board. So, interesting fact. Some VCs don't really care about this that much at the Series A level. I represented a company that was invested into that was supposed to have 2 founder seats and 1 VC seat, and the VC forgot to elect their board member. So as of right now, the company still has 2 board members who are founders. And I think it's now 1.5 years later since that financing happened. I'm pretty sure that board member still hasn't been elected. He'll get elected. It's fine. But it's funny. Some people don't really care about this stuff. Really, as your company becomes really valuable, that's when people start getting really, really... The thing is that in the very beginning, when your company is not as valuable, nobody really pays attention to this stuff, right? But when your company becomes really valuable, you see their true skin, their true colors. And it's really interesting to see VCs fight against each other at the Series B level. Series A VCs and Series B VCs fight. I love that stuff. What's up? It could be an employee. It can be not an employee, because typically the incentives are misaligned, right? Like they're still working for the company. An outsider is typically like an advisor. Say you've hired like a really prominent angel or some business person who's really good. No, the person will have a board seat, but they'll be independent. Think of it as someone who is not biased toward one side or the other, who can give you independent business. Suppose you're a Series A investor and as founders are arguing on a point and they can't agree. Your outsider will be like the most measured mind to mediate the dispute. I wouldn't pay them anything. You don't pay board members for their seats. I don't know if anybody were paying your board members. You don't pay your board members at this stage anything. It's a great career to have, to be a serial board member of a nice public company, of 20 public companies, and never do a job in your life. I want that job. But that doesn't happen at this level. You don't pay your board members anything. If it's an advisor who's an outside board member, maybe give them shares. A point or two, nothing more. Have it vest over 2 years. Five seats is a lot, but that's sort of typical for a mature Series A, Series B company. For a very early stage company who has no investors or convertible note holders, I would say 1 or 2, and both should be founders. Series A, I would actually strive for 2 founders, 1 investor. But as you get to Series B or later stage, that becomes more common. 8th point, this is short, hire a good lawyer. Your buddy who's a lawyer doesn't count. Your buddy who is a corporate lawyer probably still doesn't count because there are many different types of corporate lawyers. When I was a lawyer in New York and I did private equity law, I did not know anything about VC law. And if you had hired me, I would have been like, you are stupid because I can't do this for you. Hire a VC/startup lawyer. And don't just hire them because they say they are. Don't let them tell you, oh, I am a VC startup lawyer, therefore you should hire me. Ask them for examples, like what they've done. Who are their clients, right? If you're hiring me, and no, you cannot hire me, I'm sorry. But if you're hiring me, I would tell you, I represented Andreessen Horowitz, Excel, Index Ventures, Kozlow Ventures, Kleiner Perkins. I represented Facebook, Dropbox, Airbnb. I can tell you that, and I can tell you specific examples in which I represented them. And you can be like, okay, this guy knows his shit, hire him. All right? I can give you referrals if you need any referrals. I know we're working with one lawyer in the UAE who I think is really good. They're our lawyer, but I have no trouble recommending them to you. And they do both VC law and later stage law, and they're familiar with BVI entities, Dubai, Bahrain. So it's not a problem. And I know VC lawyers in the UK, in Germany, in the US, all around the world. So don't be afraid to ask me. Number 9, know your cap table like inside out. You should have this memorized because at this point in your company's life cycle, you should know James owns 50%. Khalid owns 20%. I have a 5% option pool. All right? And understand what the money that you take in your company will do to that cap table. If I'm an investor and I'm talking to a founder who doesn't know their cap table, I will think you're an idiot. Or I will take advantage of you. And your lawyers, if they're good, if they're worth their salt, they can prepare one for you. Not a problem. Last point here, it's called most favored nations. Sometimes you will see an investor ask for something called most favored nations in a convertible note typically. And this term will typically mean that here are my terms, but if you offer superior terms to an investor down the line, I get those terms. That's a very aggressive thing for them to ask for. Don't give that away frequently or at all if you have the power to do so. So it isn't candy, you just can't hand it out. All right? So suppose I've negotiated with one investor, an example of this, I've negotiated with one investor a $10 million cap and a 10% discount. It's a very founder-friendly deal. But that investor negotiates most favored nations. Suppose 1 year down the line, I negotiate a 30% discount and a $5 million cap. That means that those superior investor-friendly, those better terms for that investor get matched by the first investor. No, it can be in follow. It can be in later on rounds. No, it wouldn't be a down round because it's a convertible note. So down rounds are not applicable to convertible notes because convertible notes have no valuation, so to speak. Okay, so an option pool is basically saying I have 10 million shares total in my company, and I'm reserving 1 million shares for issuance to my employees when they get hired. Yeah, well, the company has those shares set aside, and they dilute the founders, so the founders don't own those shares. And you establish it by the board and the shareholders. They approve it. It's very easy to do. It's pretty applicable to that as well, yes. It depends on the jurisdiction. It's not legally required to have an option pool, but your investor will ask you for one. It typically, you can put it in your incorporation documents if you wanted to, but you don't have to in the US at least. Typically, you just have to have the board and shareholders approve it via a written resolution. They just have to vote in favor of it. So it's just like, oh, your 2 founder board members, yes, I established an option pool. Your majority shareholders, 2 founders, yes, I established an option pool. Very easy stuff. In the US, it wouldn't cost you, with a good lawyer, more than $100 to establish an option pool. It's very easy stuff. That's a good question. I recommend no. I recommend that founders should have all their shares outside of the option pool. Oh, so where's the accelerator? Good question. So 500 startups, when you enter our accelerator, we invest in a convertible instrument, $125,000 for 5% equity in your company. Pretty easy. So basically, 125 with a $2.5 million valuation cap. Very easy. We ask for 2x acquisition premium and $500,000 follow-on right, which means that if you have a later round of financing, we can invest legally $500,000 more. And
Maybe a quick note on the case.
Oh yeah, we have an investment agreement that we use called the KISS or KISS. It's called a Keep It Simple Security. Some of you have heard of SAFES. It's our competitor agreement to YC. We have KISS all around the world. We're building it out for this region as well, but it's not developed yet. But basically, you don't have to spend money on lawyers drafting these documents when you have one readily available. We have one in the UK called UKISS. We have one in Germany. We have one in the BVI, Cayman, Japan, Korea, Malaysia, Singapore, United States, Canada, soon to be Nordics.
So